So imagine breaking your arm, right? You're looking at the x-ray, and the doctor just cheerfully points to the image and says, perfectly healthy. Meanwhile, your fractured bone is literally, sticking out of your skin.
Oh, that is quite the visual to start with.
Well, I mean, that is exactly what Wall Street looks like this morning, Tuesday, June 16, 2026. On paper, the market appears flawless. The VIX, Wall Street's famous fear gauge, is tumbling back below its historical average.
Right, and the S&P 500 is flirting with all-time records again.
Exactly. I mean, the market just swallowed the largest initial public offering in human history without a single bout of indigestion.
Yeah, the surface data projects this absolute tranquility.
Yeah.
It's almost as if global commerce has just magically ironed out all its structural friction.
Yeah.
But our objective for this edition of Claire Issue Financial Candy is to look past that pristine top-line data.
Because underneath it, we're tracking a really fragmented reality where consumers, these massive tech monopolies and global central banks, are physically pulling the economy in completely opposite directions.
We really need to examine the peculiar incentives and extreme price discovery models that are reshaping everything from multi-trillion-dollar artificial intelligence investments to the tip screen on your morning coffee.
And for you listening, I want to be clear, this is not some abstract macroeconomic theory. We are tracking exactly how your wallet is being actively targeted by these new algorithmic strategies. So let's start with the event that supposedly proved the market's infinite appetite, which is the SpaceX mega IPO from last week.
Right, the numbers there are just staggering.
They really are. I mean, the company raised $85.7 billion in a single event. That capital injection pushed its total valuation to $2.5 trillion.
Which instantly elevated CEO Elon Musk to a trillionaire.
Yeah, putting his estimated net worth at $1.11 trillion, it's just hard to wrap your head around.
It is. And the mechanics of how the underwriting banks, Goldman Sachs, Bank of America, JP Morgan, how they achieved that final $85.7 billion figure really highlights the ferocious nature of current tech demand.
Because the initial target wasn't that high, right? It was only $75 billion.
Exactly. The banks utilize this financial mechanism called an overallotment, which is frequently referred to as a green shoe option. Think of it like a market safety valve. When demand is so rabid that the stock price threatens to rocket out of control and create dangerous volatility, the banks have a pre-signed contract.
Wait, so they can just magically conjure up extra shares?
Essentially, yes. It allows them to purchase extra shares directly from the company at the original IPO price. They exercise this option in full, flooding the market with an extra $10 billion in shares to satisfy buyers and stabilize the trading floor.
I'm looking at their cash flow statements right now, and SpaceX certainly needs every single cent of that $10 billion overallotment. I mean, they burned through over $10 billion in the first quarter of this year alone.
And they are funneling the vast majority of that capital into artificial intelligence infrastructure and their Starship launch vehicle.
Right. Wall Street analysts are openly debating whether investors are actually buying future cash flows here or if they're just funding incredibly expensive poetry. Because Musk is projecting $1 trillion in revenue by 2030, but that's anchored almost entirely by speculative promises of orbital data centers that, well, they do not currently exist.
That tension between funding speculative poetry and punishing actual cash flow is really the defining paradox of the current tech landscape. I mean, companies generating massive, tangible profits are facing severe market penalties.
Like Broadcom and Salesforce, right? They perfectly illustrate this contradiction. Broadcom just posted a 48% revenue jump and beat earnings expectations.
Salesforce also beat on both earnings and revenue.
Yet both stocks took a severe beating in the aftermath. Broadcom CEO, Hock Tan, he reiterated expectations of $56 billion in AI semiconductor revenue for fiscal 2026. And the market essentially shrugged and sold off the stock just because that forecast wasn't considered stratospheric enough.
It's wild. Speculative promises just don't have to contend with immediate gravity the way tangible companies do.
It feels like Wall Street is acting like a chaotic Hollywood producer. They're gleefully writing a blank check for a sci-fi blockbuster with no script, SpaceX's 2030 orbital data centers. But they're aggressively firing the reliable soap opera writers at Broadcom who consistently deliver a verifiable 50% profit bump. I just struggle to understand why these speculative promises are currently outperforming actual revenue beats.
Well, because concrete AI development has to deal with immediate geopolitical reality.
Huh?
Look at the regulatory wall Anthropic hit last week. They launched their highly anticipated Fable 5 and Mythos 5 models last Tuesday.
And Mythos 5 was specifically trained to excel at identifying software vulnerabilities,
Yeah.
right? Meant for advanced debugging.
Exactly. But by Friday afternoon, the Trump administration issued an emergency export control directive under Project Glasswing. They cited severe national security and cybersecurity concerns, forcing Anthropic to suspend all foreign access to those models immediately.
Which is huge, especially considering the Department of Defense already labeled Anthropic a supply chain risk back in March. They banned defense contractors from using their tech. AI is no longer being treated as a consumer tech product. It's being regulated like weapons-grade uranium.
And Anthropic is calling this a temporary misunderstanding over a narrow cybersecurity safeguard. But the action proves that the ceiling for actual cash-flowing AI companies is dictated by the Pentagon, not just market enthusiasm.
Right. And this bizarre separation between speculative valuations and ground-level reality, it becomes even more stark when we shift our focus to the retail sector.
Yeah, economists refer to this as a K-shaped economy. The term describes a scenario where different demographic groups experience entirely divergent financial realities. The wealthy track the upward diagonal line of the K, leveraging asset inflation and tech gains.
While the lower and middle income demographics track the downward diagonal line, just getting squeezed by persistent costs.
Yeah.
And China's May economic data paints a really vivid macro-level picture of that K-shape.
Their exports and manufacturing are surging, double-digit growth driven entirely by AI components and renewables.
However, their domestic retail sales contracted by 0.6%. So the factory floor is booming, but the Chinese consumer is completely tapped out.
And we are seeing the exact same consumer divergence in the United States domestic earnings reports this week. While Elon Musk is vacuuming up $85 billion for a sci-fi future, the people who actually build the physical economy are altering their spending habits drastically.
Best Buy just posted a 15% stock surge. Their CEO, Cory Berry, noted strong demand for high-end computing and tech necessities. They're also aggressively leaning into high-margin advertising and third-party marketplace revenues.
But then, on the completely opposite end of the mall, Kohl's is reporting its best comparable sales performance in 4 years, and they are succeeding by aggressively targeting the value-conscious, lower-middle-income shopper.
But the apparel brands stuck in the middle, the ones attempting to capture aspirational middle-class spending, they are getting crushed. Lululemon and Gap, specifically the Old Navy brand, are heavily slumping.
The profit margins for those apparel companies are being shredded by complex supply chain mechanics and shifting trade policies. Lululemon, for instance, recently lost its de minimis exemption.
Wait, isn't that the tourist loophole?
Yes, historically the de minimis rule was designed so tourists bringing back cheap souvenirs wouldn't have to fill out customs forms. But apparel companies weaponized it into a corporate shipping pipeline.
Ah, so that allowed them to ship packages from Canadian distribution centers directly to U.S. consumers entirely duty-free.
Precisely. And losing that exemption meant sudden, massive tariff applications. Those tariffs eroded Lululemon's gross margin by nearly 3 percentage points this quarter alone.
And Lululemon's interim CEO, Megan Frank, attempted to blame spikes of negative media commentary stemming from a proxy contest with their founder. But the reality is that Gap and Kohl's are currently sitting around waiting for millions of dollars in expected tariff refunds just to offset the heavy promotional discounts they're forced to run to get wary shoppers through the door.
And the pressure on that middle-income demographic isn't just coming from retail prices or fuel costs related to the ongoing Iran war. The broader healthcare safety net is contracting.
Yeah, Centene, the largest Medicaid provider in the U.S., announced employee buyouts this week.
Centene is preparing for a massive structural shift in healthcare funding. They are facing over $900 billion in anticipated federal Medicaid cuts over the next decade.
Which is happening simultaneously with the expiration of Enhanced Affordable Care Act subsidies. When a household suddenly has to absorb an extra $400 a month in health insurance premiums, they stop buying new jeans.
Exactly. That policy shift directly drains the disposable income of the exact demographic that traditionally shops at Old Navy.
You know, navigating these massive crosscurrents from trillion-dollar space IPOs to macro-level healthcare policy altering mall foot traffic, it requires a sharp, curious mind. For you listening, keeping your edge in this K-shaped economy is vital. You can find more financial candy, brain candy, and classic audiobooks at claranoratio.com to ensure you're getting the full picture behind the headlines.
And it's important to realize the corporate sector is not merely observing this economic divide. They are actively weaponizing it. We are seeing extreme algorithmic yield management applied to services and mass entertainment.
Like the upcoming 2026 World Cup across the US, Canada, and Mexico, it's serving as the largest scale trial of this pricing mechanism in human history.
If you've tried to buy concert or sports tickets lately, you have probably felt this next algorithm personally. FIFA is applying aggressive American football-style economics to the globe's biggest party.
Because historically, host nations used taxpayer money to build massive stadiums that often became abandoned, rusting white elephants after the tournament ended.
But for 2026, FIFA avoided that capital expenditure entirely by renting existing, privately funded NFL stadiums. And instead of a traditional set-price ticketing model, they are utilizing dynamic pricing to squeeze the absolute maximum revenue out of every single seat in the building.
FIFA's algorithms prize revenue maximization far above simply selling out a venue. They're tracking browser histories, local demand, and time of day to push initial ticket prices into the thousands.
More drastically, FIFA has integrated the secondary scalping market directly into their own official system. Fans can resell tickets on the official platform with absolutely no upper price limit.
And FIFA then takes a 15% cut from both the buyer and the seller on every single transaction. They've completely captured the scalper's premium for themselves.
Even the basic transit logistics are dynamically priced based on that captive demand. New Jersey Transit is charging $100 for a commuter train ticket to MetLife Stadium that normally costs $13.
$100 just for the train. If an algorithm constantly squeezes the absolute maximum willingness to pay out of every single transaction, it fundamentally destroys the mass part of mass entertainment. We are systematically gentrifying the concept of fun, ensuring only the top diagonal line of the K-shaped economy can participate in major cultural events.
The entire objective of dynamic pricing is to locate that top 10% and extract their surplus capital, leaving the bottom half structurally priced out. And this microtransactional squeeze is also being exported globally via the service industry.
Right, tipping culture. It's long been an American anomaly, but it's aggressively spreading to historically non-tipping nations like Iceland and Mexico.
The invasion of American tourists carrying cultural habits is only a small part of the equation, though. The primary vector is the digital payment interface.
Companies like SumUp manufacture the ubiquitous card readers you see at coffee shops and bakeries. Those readers are programmed to automatically prompt the user for a percentage-based tip, inserting friction and social pressure into the checkout process. In the United Kingdom, the number of cafes digitally asking for tips jumped 78% between 2022 and 2024.
In the United States, that tipping prompt serves a much deeper structural purpose. Federal minimum wage laws dating back to 1938 allow employers to pay tipped workers a sub-minimum wage of just $2.13 an hour.
So the digital prompt on the iPad is not just asking for a gratuity for exceptional service, it is literally crowdsourcing the employee's base salary directly from the consumer at the point of sale.
Tipping has become such a volatile economic pressure point for the tapped-out consumer that both Donald Trump and Kamala Harris recently pledged to reduce federal taxes on tips, attempting to treat gratuities as a protected class of income.
The everyday consumer is being algorithmically squeezed at the stadium, at the coffee shop, and at the mall. And because that retail class is financially exhausted, massive pools of speculative money are hunting for returns in increasingly strange financial instruments.
When domestic mega-cap tech feels fully priced and consumer retail is violently volatile, capital flows toward historical anomalies and extreme leverage. The Bank of Japan just triggered a massive shift in global liquidity.
Yeah, on Tuesday, they raised their short-term policy rate to 1%, which is a level the country has not seen since 1995.
They are battling imported domestic inflation sparked by the ongoing Iran energy crisis. The Japanese government spent $73.5 billion intervening in the currency markets just to prop up the yen.
And despite that massive expenditure, the currency continues to slide. This disparity has triggered the return of the infamous yen carry trade. Let me put the mechanics of a carry trade into human terms for a second.
Go for it.
Imagine you can secure a massive loan from a bank in Tokyo at a 1% interest rate. You take that cheap Japanese yen, instantly convert it, and invest it into high-yielding global assets, like U.S. Treasury bonds paying 5%, or tech stocks. You pocket the difference risk-free, assuming the currencies remain stable.
And because global market volatility is relatively low right now, leveraged hedge funds have built up the largest bearish bet against the yen since 2017. They're borrowing massive amounts of depreciating Japanese capital to fuel speculation in other markets.
And one of the primary destinations for that speculative capital is a newly approved financial instrument that essentially abandons the concept of time. The Commodity Futures Trading Commission, the CFTC, just permitted the prediction market platform Kalshi to offer perpetual futures, or perps, on cryptocurrencies domestically.
To understand how dangerous this is, we must look at how traditional futures work. A regular futures contract requires a trader to buy or sell an asset at a specific price on a specific, legally binding expiration date.
But a perpetual future allows a trader to speculate on the price movement of an asset without ever actually owning the underlying asset and, crucially, without any expiration date. Imagine betting on a horse race that literally never ends.
And Kalshi is offering these contracts with up to 6 times leverage. CFTC Chair Michael Selig defended the approval, arguing the United States needs to onshore these products to regulate them safely, entirely dismissing concerns from watchdogs that the 6x leverage is dangerously high for retail participants.
So we have traders borrowing depreciating yen to place leveraged bets on never-expiring crypto contracts. Capitalism has become so hyper-efficient at squeezing every drop of profit out of traditional earthbound assets that investors are literally leaving the planet's atmosphere to find an edge.
Yes, the demand for quantum computing is creating an acute supply crisis for an isotope called helium-3.
Helium-3 is used in dilution refrigeration. By mixing helium-3 and helium-4 at near absolute zero, scientists induce a phase change. As the atoms separate, it creates a massive cooling effect that is mathematically essential for keeping quantum computers stable.
But a single liter of helium-3 currently costs roughly $2,000. The primary source right now is the decay of tritium inside nuclear weapons, and that supply is heavily bottlenecked by international treaties.
So several companies are betting that the moon is the solution to this terrestrial bottleneck. Companies like Interloon, founded by former Blue Origin executives, and Astrotech are planning to launch autonomous excavators to the lunar surface.
The engineering constraints are staggering, though. They want to scoop up lunar dust, heat it to immense temperatures, and extract the helium-3 trapped inside the regolith by billions of years of solar wind.
Lunar concentrations might only be 20 parts per billion. Extracting a single kilogram of the isotope could require processing hundreds of thousands of tons of moon dirt.
Meanwhile, terrestrial competitors like Pulsar Helium are simply trying to drill for it conventionally in Minnesota. They're making the rather grounded argument that the Earth's crust is considerably easier and cheaper to access than the Sea of Tranquility.
That does seem a bit more practical. But, the overarching pattern across all these seemingly disconnected sources, from lunar mining to FIFA's dynamic pricing, is the ruthless elimination of systemic slack.
The financial mechanisms governing our daily lives are highly tuned to capture surplus. Whether it is a bank utilizing a green shoe option to stabilize an $85 billion IPO, or a card reader crowdsourcing a barista's wage, the objective is absolute efficiency.
And these mechanisms generate staggering wealth at the top of the K-shape, funding orbital data centers, while systematically starving the bottom half of the economy by pricing them out of basic participation.
Corporate America and these dynamic algorithms possess unprecedented skill at extracting the maximum yield from every single consumer interaction.
Which brings us to the ultimate question for you to consider today. What happens when the software discovers that the bottom half of the K-shaped economy mathematically has no yield left to give? Does the dynamic pricing model finally break under its own weight, or does it just shrink the size of the audience entirely until only the billionaires are left in the stadium? We are staring at a diagnostic X-ray where the economic machine has become so precise it has run out of bones to pick clean. Keep an eye on your wallet.